Hello. Yeah, it's visible. So today, good afternoon, everyone. This is Tarika Agarwal, and I hope I have been introduced well. I've been working with Deloitte since last 10 years, more than 10 years, on expat taxation, majorly expat dealing with NRIs, residents in India, non-residents going out of India, coming to India. Likely what he mentioned about GCCs, which is the current topic and current favorite of all industries. They have been setting up in GCCs in India, so it's very critical for all of us to know what is NRI taxation. Are there any benefits for non-residents in India, and can we take a beneficial rate of tax under the DTAAs which are applicable? So we'll go through each head of income as well as scope of taxation before starting to okay, so what we're going to cover today is residential status. As we, it's a relearning session. We need to learn about residential status. Sometimes there have been a lot of amendments in residential status provisions as well. The last amendment happened in 2020 on deemed residency concept. So I want to take you all through that and what are the integrities on that. The scope of taxation depends on residential status. There are three legislations which are governing this. One is Income Tax Act. There is DTAA, which is the Double Taxation Avoidance Agreement. And there is FEMA regulations also, which is governing the non-resident. So why is that important? What is the residential status under each of them? We'll discuss more on this. Taxability of income under each head, which is salary, house property, interest, dividends, capital gains. What are the reliefs available under the DTAA in respect of these income? Special provisions related to non-resident on capital gains. So there is a chapter, special chapter, chapter 12 in the Income Tax Act itself. FEMA regulations on a high level basis. What are the regulations primarily applicable to a non-resident? And practical difficulties which NRIs face in India. What are the nuances? So before starting, I'll just add if you all want to, share your experience on what you all have gone through. It will be helpful. We can have a two-way round of discussion rather than just I am speaking on my experiences because I will have experience of the industries which I am serving. If you all have some experience, do share. Residential status. So what I mentioned earlier, there are three legislations, which is the Income Tax Act, the DTAA, and FEMA. So it's not necessary a person who's resident under one act could be a non-resident under DTAA. So if it's resident under income tax, non-resident under DTAA, or a resident under Income Tax Act, but a non-resident under FEMA regulations. So each and every regulation has its own ways of criteria for determining the residential status. Now, why is that relevant? So if we have to see Income Tax Act, the residential status helps us to determine the scope of taxable income. What is taxable in India? What is not taxable in India? That will be dependent on the residential status. Now, that will also help you to for reporting requirements. For example, like residents are taxable. I can have a better. So residents are required to report their foreign assets in the India tax return, while non-residents are not required to. So that is why it is important to know the residential status under the Income Tax Act. Now, why is it important to know the residential status under the DTAA also? Because if you want to claim relief under the DTAA, because if a person is liable to be taxed under both the regulations in both the countries, in India as well as in the overseas countries, because of his stay or any other reason, then residential status under the DTAA is also has to be determined to claim a relief. So residential status under the Act will not help you to go for DTAA relief. You need to check the residential status under the DTAA. Why is residential status under the FEMA regulation important? Because that will help an individual to know how much he can remit outside India, what are types of accounts he can maintain. If he is a PROI, which is a permanent person resident outside India, then only the NRE interest is exempt. So income tax has also referred to residency under FEMA to exempt the NRE interest. So there are regulations, Income Tax Act, DTAA and FEMA all three regulations, residential status, one has to determine before proceeding with income tax return filing as well. In order to determine the residency under each of the laws, what is important, you need to maintain your passport copies, the arrival and the departure stamps, also the intention of if the person is going out of India or coming to India, what is the intention, that is also very important to determine the residency under three legislations. Coming to the first act, which is the Income Tax Act, Section 6 determines or governs the residency rules. The basic rule says, Section 6 1, there are two criteria. One is your stay should be more than 180 days or more. The second criteria is, as you might you all know, that 60 days in the financial year and more than 365 days in the preceding 4 years. So this is basic. If none of the conditions get satisfied, then you straight away qualify to be a non-resident of India. But if any of the conditions get satisfied, then the other condition to determine you qualify to be a resident, but there is subcategory which is resident and ordinary resident, resident and not ordinary resident. Now, to qualify as a ROR, you need to be either stay in India for more than 730 days or more during the preceding 7 years, and 2 out of 10, you need to be resident in 2 out of 10 financial year, preceding financial years. But if none of the conditions get satisfied, then you become a RNOR, which is resident but not ordinary resident. Now the twist here is, this were basic provisions, but the 60 days criteria, which was the first criteria, is not applicable to a Indian citizen who is going for the purpose of employment outside India, or an Indian citizen or a PIO, which is a person of Indian origin, who comes to India for visit. So he's been staying outside India for a long period of time, just comes to India for visit, and his then the 60 days rule does not apply. The other rule applies is if his income is more than 15 lakhs, then he has to look at the 182 days criteria. If his income is less than 15 lakhs, India sourced income is less than 15 lakhs, he has to look at the 120 days criteria. So this was an amendment which was made in the previous years, and very important, because if your income is more than 15 lakhs and your stay is more than 120 days, if an Indian citizen coming to India just for visiting, then he will be an RNOR and not a non-resident directly. So this was all about physical stay days. So physical stay days determined residency in India. But there was another concept which was brought in by the Finance Act 2020, which said about the deemed residency concept. Now, deemed residency concept is not on the physical days in India; it is on the citizenship of a person and other criteria. So there are other countries also which is following citizenship based residency, like US, where a person who is a US resident, a US citizen or a green card holder is always a resident of US, has to file a worldwide income taxability. This concept was not in India, but this concept has been brought in India. There are reasons behind it, because people were evading tax by just not satisfying the physical days criteria, especially the Indian citizens. So the Indian citizens, so what the concept they bought is, there are three conditions to be fulfilled to be a resident. One is you need to be a citizen of India. The second is your income is more than 15 lakhs during the financial year, India sourced income. And third, you are not paying tax. You are not liable to tax in any other country. If these three conditions get satisfied, you become a deemed resident of India. So that was a twist to the earlier provisions, where only stay was considered as one of the criteria for determining the residential status. In this situation, stay will not matter. Even if the person is not staying in India 0 days in India, but he is a citizen, he has income more than 15 lakhs and he is not liable to tax in other countries, then he will be a deemed resident of India. Now, this amendment brought a lot of questions in the minds of people who are working in Middle East country like UAE and Dubai, where there is no taxation. So, does this provision mean that Indian citizens going out of India to Dubai, working there, are liable to pay tax on that salary which they have earned in Dubai? Any thoughts on this? So if an Indian citizen who's working in Dubai and having 15 lakhs income, citizen of India, not liable to tax because there is no taxation in Dubai, as we all of us know. In the Middle East countries, there is no tax liability. The domestic laws only don't determine. So what the government said that the intention is not that. So they brought in a press release in 2020, Feb 2020, to say that the intention is not to tax those individuals who are working out of India and and tax in India for no reason because they are not liable to tax in India. The intent so these individuals will not be taxable and they will qualify to be a RNOR. It's not resident an ordinary resident. If you are a deemed resident, you will be an RNOR, not an ROR. It's a resident but not an ordinary resident. So your income which is accrued in India, deemed to accrue in India, that will only be taxed in India. Or if your business and profession which is controlled by India, that will be taxable in India, not income which is earned outside India. So that clarification note was issued by the CBDT via press release in February 2020 that such individuals earning outside India, that income, the purpose is not to tax those. The purpose was to tax if the person is non-resident but having business controlled from India. Uh, the intention was to tax those individuals. Yeah, you have a question.
Only if the India source income is greater than 15 lakhs, then it becomes.
Yes.
The example you give, if the income is entirely in Dubai, that wouldn't be qualified.
That wouldn't qualify 15 lakhs. Yeah, it is only India sourced income. Correct.
And only where income exceeds 15 lakhs. So
Yeah.
that is 14 lakhs.
This deemed residency concept doesn't come into picture. India source income should be more than 50 lakhs. So HNIs, the purpose of the government is to track. So HNI is going out of. So what they do is they plan their visit in such a way that in each of the countries they are less than the minimum threshold which is required to be a resident in that country. So every country has 182 days, or some countries have 90 days clause to become a resident. So what they do is they jump from one country to another and become non-resident in all the countries and not pay tax in any of the countries. So the objective was to catch hold of such individuals.
For example, ideally,
Yeah, sorry.
if you have income outside India, recognize and all these people, in respect of income earned outside India, they do not want to pay tax in India.
Correct. Yes.
So the Indian income is taxable in
any case. But if it is a business profession which is controlled in India, it's not taxable for a non-resident, but it's taxable for a resident but not ordinary. So that is the.
So they have business income
from India, but they are staying outside India and qualifying as non-resident, they were excluded from taxation.
Yeah, so index income is from interest.
Sorry, you have?
Index income, interest income in India.
Yeah.
They are earning in Dubai. The whole income will be taken in
Only 15 lakhs, which is India, because he is an RNOR, which is resident but not an ordinary resident. So resident, not ordinary residents are taxable only on India sourced income and business profession, which is controlled from India. So salary received outside India for services rendered outside India is exempt for them. So the intention was not to tax those individuals. That's why the press release was brought in.
Criteria to say that business is outside India, but it's not from.
Sorry, what is the criteria?
Basically, you said that those RNOR will be taxed in respect of those foreign income which controlled from.
So if they have business income which is controlled from business profession in India.
How do we determine that the business is controlled? NRI is controlling the running of business outside India. But it is being governed.
They have a setup. If there is a P in India, there is a setup in India, and it's been controlled. The directors of the companies are in India. Then it is controlled in India. So there are a lot of criteria to check. Yeah.
So basically, your directors or bankers should be outside.
So everything outside India, nothing in India. Yeah. Yeah.
If there is nothing in India, then nothing will be.
Nothing.
Yeah. Something will be in India, but that something should be immaterial.
If it is immaterial, it is not controlled through India.
I think besides chartered accountancy firms, all this seems to be a bit of a make-believe kind of scenario where you would wonder what people do. I mean, they are managing their affairs in such a way that the control is there, but the income is elsewhere, and they don't pay tax. It all seems like a kind of a make-believe world. And I think for large organizations, I'm sure there are such people who are doing this, who are spending all the amount of time on doing this. I think they are also ably assisted by chartered accountants to do all this.
Yes. So that's it. You had a question, so I have to take.
So in one scenario, like one employee is on the payroll of Dubai, but for some reason more than 6 months in India for some project, but he's getting paid in Dubai.
Okay.
Then in that case, we have to pay the tax for that money.
So is he working for the Indian entity? The question is he working for the Indian entity?
Yeah, if he's like India has a project office, the same the head office is in Dubai.
Correct.
So he's earning there, but he's like for some reason, because he has a knowledge, he's coming to India.
Correct. So it's on a deputation. Correct. Kind of a deputation, short term.
He's not, he's coming on business visa, not on.
Acha, not an employment visa. Okay. Still, it can be a deputation. It's not necessarily an employment visa, a short term visit to India. But then DTAA relief can be taken because India Dubai has a DTAA between both the countries.
Right.
So under Article 15(2) of India Dubai, if he is coming for less than 90 days and that salary which is paid to him in Dubai is not cross charged to India, so Indian entity should not bear that cost.
Okay.
Because if it's hitting the PNL of the Indian entity,
but if it is cost to cost, then also it will be.
Yeah. If they are taking that cost in their PNL, somewhere they are taking a deduction of it. So that then that employee's salary will be taxable in India. If those conditions get satisfied, that it is not getting cross charged to India, the overseas entity does not have a PE in India. So there are three conditions. If those conditions satisfy, then he will, and he has to be a resident of Dubai as well to claim a treaty relief. So treaty allows to exempt such short visits in India.
Normally you don't get the residency.
No, residency, they are residents. They don't pay tax. Residency and taxation is different. So they get residency certificates. They may not be paying tax because the domestic laws are designed in such a way that they don't need to pay tax. But they do get residency certificates to say that they have been resident because of their stay in Dubai. Uh, uh, just to sum up, these are the relevant criteria to determine a residential status in India as per the Income Tax Act, which is the physical stay, length of stay in the previous 10 years, including the financial year concerned, citizenship because of the deemed residency concept, intention of leaving out of India, or the purpose to come to India. The intention also matters. If you are going for the purpose of employment, then only that exception is there. It's not for everyone. So the intention matters. We'll also look at some case laws on this in our subsequent slides. Now, residency under the DTAA, which is the Double Taxation Avoidance Agreement. Now, Article 4.1 of generally of all the treaties talks about the residential status of a person under the DTAA. Now, Article 4.1 is very clear to say in most of the treaties that residency as per your domestic laws of the contracting state becomes a residency under the DTAA also. To give an example, if a person is working in India, goes on a deputation to UK, and he's a resident of India, and in UK, if he's a non-resident under the domestic laws, 4.1 will also say that he's a resident in India and non-resident of UK. The question comes, and the main objective of DTAA interplay comes here is when he's a resident under domestic laws of both the countries. Assuming as per the domestic laws, Income Tax Act, he's a resident of India and a resident of UK or overseas country, then what will happen? How can we claim a relief? So Article 4.2 is a tiebreaker test. What it says, if a resident under Article 4.1, which is under the domestic laws of both the states, then the tiebreaker rule will be applicable. The tiebreaker rule says that you have to if the conditions which are mentioned, the four conditions, if that has to be read in a sequential manner, if that is getting satisfied in whichever country it gets satisfied, you become the resident of that country. To take an example, the first condition is availability of permanent home. Now, permanent home could be a rented accommodation or an owned accommodation, but if it is available to the person, so if an Indian citizen who goes out of India, he still owns his family home. Like he's not rented out, he's not sold that house. It's available to him whenever he comes back, he'll stay in that house. So it's always available to him for stay. So India will have availability. So in his case, it will be available to him in India. Similarly, if he has bought a house in UK for his staying, maybe a rented or otherwise, then that home is also available to him because it is available to him for his stay. If you are not able to determine residency based on the first criteria, then the second criteria has to be looked in. which is center of vital interest, which says about social and economic ties. Now, social and economic means socially where you are more closer to, like your family is staying, your near dear ones are staying, your dependent parents or dependents are staying. If they are staying in India, then you become a resident of India. If they are staying outside, then your social ties are more closer to outside India, then you become a resident of that country. Or economic ties. Economically means where your major source of earnings are, where are your retirals, your PF, your social security contributions. If that is the situation, if that all is also outside India, then the person will be a resident outside India. If that is also not, you are not able to determine residency based on this criteria as well, then the next point here comes is habitual abode. Habitual abode is where the person has been living for the most period of his time in which country. So if he is living in India for maximum period of time during that financial year, then he becomes resident of India. If he is staying in the other country, then he becomes a resident of that. And if that is also not determinable, then nationality becomes the last course of uh, uh, if the person is a national of which country, then he becomes a resident of that country. So these are the criteria. While income tax act doesn't specify about split residency. Now because of this test, if a person is going from India to abroad in October, then from October to March we will have to see split residency. But Indian income tax act does not define split residency. It is only under the DTAA which it comes. So there have been rulings. There is a landmark ruling in Delhi ITAT decision where, in case of Raman Chopra, where it held that tiebreaker is a stand which can be taken, and if the person is resident of overseas, then the India income will not be taxable if these conditions are satisfied. Also, there was a BMA circular by CBDT which says the concept of residency under the tiebreaker clause. So there have been case laws and circulars to uh, give importance to that. There is a concept of tiebreaker in India under the DTAA. To give No, it's in most of them. So I've just given an example to have the wordings. In most of them, it will be the same wordings, just here and there some points. To give an example, if an outbound employee, if working for the Indian entity, going on a deputation outside India from 31st October in this example. So April, and since he's been there for more than 182 days, he is a resident of India. So resident of India under the Income Tax Act, it will be for full year, which is 1st April to 31st March. Now, when he moves to UK, under the UK laws, domestic laws, he becomes a resident of UK as well from 1st November to 31st March. Now, the question is from 1st April to 31st March, he is a resident only of India. But from 31st March to 31st October to March, he is a resident in both the countries, which is UK as well as in India. So we need to check the tiebreaker clause under the DTAA to check whether he is resident of India or UK, depending on the conditions which we discussed. So if he is qualifying to be if the tiebreaker conditions are in favor of India, it becomes resident of India for the second half period as well. If it is in favor of UK, it becomes resident of UK. Any questions on this? Only for the second half. Second half, because UK is taxing him only from second half. The first half is they are not they have not considered him as resident. So that could be Indian national income not be taxed. For which, yeah. So if the person is tie breaking to UK, so he becomes a resident of UK, non-resident of India under the treaty. So not taxable in India. Though he is a resident under income tax resident. So while filing the income tax return, you will show as income ROR, but you will not show 31st October to March income. Okay. Because he is tie breaking outside India. Can he take option as being ROR, he can take the relief of that tax for he's paying show income here also. Yeah, so that's another concept, which is the foreign tax credit method, where you tax the entire income for April to March, and you take a relief of whatever taxes, but not necessarily the tax in the other country would be as high as which is there in India. That depends upon the then exactly. So if it's in India is 42 and in other countries just 20, then he will have to pay additional 22%. So which will not be beneficial. If that's the case, then we can take. But that's more you're offering to tax and then claiming a relief. This option is very feasible that you are not taxing at all. If the conditions are satisfied, you need to look at each case separately. Now, residential status for an individual as per the FEMA regulations. Now, FEMA classifies resident into two categories. Unlike income tax, which there are three categories. Under FEMA, it is only two categories, which is PRI, which is the person resident in India, and PROI, which is person resident outside India. The conditions are very simple. Who qualifies to be a resident in India as per FEMA? If your previous year stay is more than 182 days, then you qualify to be a resident under FEMA. But there are two exceptions to it. If a person is going to take up employment outside India, if he's going in that year, or he's for a business purpose or vocation or for an uncertain period, not necessary employment, but for any reason, but for an uncertain period, if he's going outside India, from that year he becomes a PROI, which is a person resident outside India. He will not be a resident of India under FEMA regulations. Uh, to take another way around is if a person is coming to India, if a person is coming to India for employment, he will not be a PROI. It will be a person resident in India. From the day he comes to India, he becomes a resident of India under FEMA regulations. Then the previous year stay is not required to be checked for FEMA regulations. So if a person is coming for employment, business, vocation, any other purpose, the intention is to stay in India for an uncertain period. It should not be that he's coming just for 1 month, for a medical reason, for a tour, just tourist coming on a tourist visa. That is not included here. It should be for a longer duration of time or an uncertain period. If he's coming to India, then he becomes a person resident in India. If we similarly, if a person is going out of India for an uncertain period, not for tourist or medical reasons or any other reason, then it will be a PROI, which is person resident outside India. Yeah, I don't know. Yeah, you can take photos. So, can we share the presentation later with this? No? Good. Okay, it's shared. Okay. You wanted to put it's done. Okay. So residency is determined under all the three, which is income tax, DTAA, and FEMA. Now we'll go to the scope of taxable income. Now, under the Income Tax Act, it's very clear residents are taxed on global income, RNOR are taxed on India, received, deemed to receive, deemed to receive, accrue, or deemed to accrue in India, and business profession, which is controlled from India. And non-residents are straight away taxed on only received or deemed to received or accrued or deemed to accrue in India. Now, there is still questions on what is accrue deemed to accrue, because received is very clear that it is received in India, but accrue deemed to accrue, how do you determine whether that income is accrued or deemed to accrue? So there is section 9 in the Income Tax Act, which tells about which type of income will accrue where. So it has to be, if salary income is it accrued in India or outside India, depending on what are the conditions to determine accrual. And taxability under the Income Tax Act is based on the scope of taxation, which is section 5. But there is, if the provisions of DTAA are more beneficial, one may go to the DTAA provisions as well. So section 90 of the Income Tax Act do give reference that if the domestic laws tax you for something and the DTAA exempts you and it is beneficial, go for that provisions. But 90 also tells if you need to go for DTAA benefit, you need to also obtain a TRC, which is a tax residency certificate from the overseas country. So if you have obtained that certificate, then only you can go for a DTAA benefit. So that's a primary condition for claiming any DTAA reliefs in India. For example, Cayman doesn't give TRC. Exactly. So that is part of my practical consideration. There are a lot of countries who don't give when you are filing the return, because their laws will be, their timelines are different. There are countries who do not give. Cayman Islands doesn't give. Egypt doesn't give. So there are countries who don't. So there is a case law on that as well, which says that TRC is not the absence of TRC cannot be a denial of exemption. Right. So if just because I didn't have TRC, if there is an overseas return which says that he's a resident, there are substantial proof to substantiate, then it can be argued. So there's only one case law on this till now to say that TRC cannot be the only reason for denial of exemption.
What is the importance of Form 10 also?
Yeah. Yes. So that's the next part. So TRC is there. If you have obtained TRC, but TRC will not have all the details which the Indian authorities need. For example, what the Indian authorities need is name of that individual, status, whether he's an individual, foreign company, HUF, or etc. Nationality, identification number of that country. Like India has PAN number, whatever the TIN number or identification number that person has in that other country, residential status in that other country, address of the taxpayer. So these are the prescribed details which a TRC should have. If these details are not available in the TRC of the country from where you have obtained, you need to file a Form 10F, which has to be filed electronically since last, I think, 2022. They brought in this new concept of filing 10F electronically. Earlier, it was manual filing with the authority, with the income tax authorities. Now it is electronic filing, which is on the income tax portal, and it has to be e-verified by the person who's filing it. So, and attaching the TRC. So once you get the TRC, you need to also file E10F and attach the TRC along with 10F on the income tax portal. So whenever you claim any treaty relief in the Income Tax Act, what we have seen currently is income tax authorities have been issuing notices that you have not filed 10F and you are claiming treaty relief in the income tax return. So if that is the situation, you will have to file 10F immediately, else there will be denial of exemption claimed. Yeah, so that is if you are claiming a foreign tax credit.
Foreign tax credit.
Yeah, which is foreign taxes which are claimed as credit in India. If that is the situation, then you need to file Form 67. This is when you're not taxing that income. Assuming foreign income and you are not a resident of India as per the treaty, you are not taxing that income. You are claiming a relief under the DTAA. Then you need to file Form 10F along with TRC.
If you are taking a credit, taking that income into consideration, then you have Form
67.
What she's telling is if you're not taxing that into national DT, then you have
There are two ways you can, take a relief under DTAA. One is exemption method where you are not taxing at all. One is foreign tax credit method where you are taxing that income and you are claiming a foreign tax credit of whatever taxes US is or whatever country has paid. So if 100 is the salary which is paid outside India, you want to tax that income in India, you tax that income and you whatever taxes are paid US में 30 rupees. So 30 rupees ka you take a credit.
For that, you need to file form.
For that only Form 67 is there.
So largely TRC and Form 10 is for people who don't want to subject the income to tax in India.
Exactly. Yeah.
67 is the other way.
Other way around. Where you tax it and you claim a relief. So there are two.
Or largely for larger basket, either Indian companies, Indian nationals who are subject to tax in India and also have overseas stuff. But they have been double taxed, therefore they want the relief. Then you pay this.
So 67 comes into picture mainly when the person is resident in India, as per domestic laws, ROR cases. If you are a non-resident and if you have got some income in India and you want to claim a relief, then you need to file TRC and 10F. Yeah. So non-residents generally opt for TRC.
Someone is paying for over revenue for over
Yes. TDS. Exactly. Exactly. Yeah.
Is there any option to apply for successful rate?
Yeah, under 197 you can apply.
That also can apply.
Yes.
You want to reduce the rate of credit.
Yeah, so that is part of 15 CA part B of 15 CA where you apply for and then when you are remitting outside India, you do not need to provide any proof. If you have already obtained a certificate under 197 concessional rate. Yeah.
And in this case,
the date of payment. Yeah.
Like you said, certain countries do not have the TRC, so might give you a TRC which is not valid on the date of payment but the previous one. And they might say that they would get the documents say later on after 6 months or 3 months once they get. So what can be done in that?
Then the TDS will have to be deducted. You can't pay without exactly without the documents, because then it's a non-compliance from your end.
In that case, TDS deducted, and later on, the say after 1 month we get the certificate. Can we revise the
Or maybe make the payment at that time when the certificate is available.
So we can make the payment of the differential later on and consider.
No. So TDS they will have to claim as a refund in their return. They'll have
Just for an example of dividend payment. So dividend you have to pay to all the shareholders at the same time.
correct.
At the time of the payment of dividend, we did not get the TRs.
Hmm.
But after 15 days, the shareholder comes that, okay, finally now I have got it because my country was not giving. So can we consider that and then remit the differential to them and revise our TDS return?
No, so for dividend specifically, it has to be deducted 20% for a non-resident. By an Indian company who's paying a dividend to a non-resident, they have to deduct TDS at 20%.
The TRC benefit can be, it's not taxable in
But
India.
it will be taxable. If it is paid in India, it will be taxable for a non-resident. It's taxable at a special rate, not a higher rate, but it will be taxable. You can't exempt that income.
Yeah, the lower rate.
Lower rate, yeah, beneficial rate, yeah.
Because deducted at a higher rate, can we give that benefit of the lower rate later?
No, that provisions is not
Because on
there.
the date of payment, it was not.
It was not there, exactly, because it become very difficult to track.
But that is the practical approach we have to see, right? So because that assessment will for whole financial year, that is not the only for that.
But the company is paying just once, so the company will be taking the records and then deducting the tax.
And on the date of record, when it's finalized, we don't have the DR.
TRC 10F. So generally individuals or companies who are outside India qualifying and non-resident, they obtain TRC for the entire fiscal year. So whenever the payments are made to them, they just show the TRC.
So with Dubai, so Dubai is currently not giving for the entire year. So they are giving, so we got a TRC for the 30th June 2024. And
because future years, how one will be able to?
So ideally valid for it for an entire financial year, say from April 2024 to March 2025.
Correct.
But we have got something which is valid only till 30th June 24, and we are paying say dividend on 5th of July. So in that case, he said that the one valid till 31st July will be available post 31st July because Dubai is not giving a TRC, which has already lapsed. Correct. So they can't on 30th June they can't issue a TRC till valid till 31st July. So that's a practical challenge, which
exactly, because this earlier it was manual filing of 10F, so still a backdated thing could happen, but now it's e-filed and you get notices on the spot.
I think because of immediate that should solve this problem because that time I have paid, but later on it is billing me for that period.
But you net of TDS, you have already paid, but you have to pay more then again, another remittance to the non-resident. Yeah.
But what are the person actually is a non-resident, but in income tax profile is showing as a resident.
So a letter has to be filed with the income tax authorities, giving the passport copy to change it, because if you until and unless it is not changed, you will have to show Aadhaar number. It will be shown as an Indian person. And when filing the PAN application, it is assessee will not be able to change it. It has to be through income tax authorities. So I think last 2-3 years back, we also faced this lot of challenge, and we went to the income tax authorities and told them to change it because the foreign nationals didn't have Aadhaar, and they are not required to obtain Aadhaar. So the returns were not getting uploaded if we are not. Okay.
The property here, and you have purchased that property. Okay. So for non-resident, the 20% period has to be deducted.
Correct.
Otherwise, it is a 1%.
Correct.
So we check up their profile, income tax profile. If we show that I am a resident of that.
But he's actually not.
He actually is not.
So he will have
what
to.
tax has to be deducted?
Okay, but because his passport is a foreign national passport, yeah. So ideally, to be on conservative basis, it has to be 20% because that's a wrong income tax. Because when he's filing maybe PAN application, he chose the wrong PAN number, form 49. There are different forms for a foreign national and for an Indian national. Oh, if he's Indian citizen, so a foreign. Okay, but his passport is Indian nationality passport. Passport determines your nationality. So you need to check the passport. If the passport has nationality of Indian, then he is an Indian citizen 1%. So he's a permanent, maybe a PIO or an OCI card holder, overseas citizen of India. So if that is a situation, it will be 1% and not 20%. He's not a non-resident or uh, uh, foreign national. Yeah, he's not. He's not that.
So that means for the person Indian citizen, it is having been who left India, but having the ancestral property and he is selling it. So
Hmm.
we are supposed to cut the tax at the rate of 1%.
No, but his residential status has to be determined. If it is
Residential status as per income tax portal into the resident.
income tax portal doesn't determine residential status.
Residential status you have to declare every year based on your
The income tax department.
tax department जो होता है resident non-resident
But that is not a determining factor for determining TDS at least. That cannot be because that is maybe an old residential status or something
to the facts.
as per the current financial year. Current financial year. Moving on to income from salary. So we'll go each head wise. Now salary. The charging section is section 15, which says due or paid, whichever is earlier, it becomes taxable as salary income. Now, for a non-resident, so our focus more is towards non-resident today. So, non-residents are taxable only if it is received, deemed to receive, or accrue or deemed to accrue. Now, accrue or deemed to accrue is defined under section 912. Now, 912 specifically for salary says that salary will be deemed to accrue or arise in India only if it is earned in India. Now, what is earned in India? There was questions on how do you determine whether it is earned in India. So, an explanation was brought in under this section to clarify what is earned in India. It says that salary payable for services rendered in India and rest or leave period succeeding or preceding for services rendered in India and forms part of the service contract of employment shall be regarded as income earned in India. So, only if it is for services rendered in India, then it becomes salary accrued in India or taxable in India. If we have to say other way around, if it is received outside India for a non-resident and accrued outside India because services are rendered outside India, it is not taxable.
During this COVID period, there was a work from home, and so many people have
Correct.
come to India and
they have been stuck in India. Correct.
They have been working from India, but
Correct.
for their foreign employer, they are getting salary from the foreign country.
Correct. Correct. So there is DTAA relief then. Yeah.
But technically speaking, that service, that salary will be considered to be earned in this case.
So there could be double taxation because overseas country will also tax that income because it's received there or it pertains to their employer. It's for their jurisdiction. So there could be double taxation and treaty reliefs can be taken. That's the only way out because that time there were difficulties because people were working from India for the overseas entity. So receipt of salary doesn't matter actually. What matters is where the services are rendered. So if the services are rendered outside India, it pertains to overseas period. It is accrued outside India, and if it is rendered in India, then it is accrued in India. So there have been a lot of case laws to justify this. So there have been landmark rulings in case of Prahlad Vijendra Rao, if you all have heard about in 2011. The Karnataka High Court very precisely mentioned that even if salary is received in India by the Indian employer, paying to that employee, but he's on a deputation outside India and working for the overseas entity, then that salary will not be subject to tax in India just because it's received in his Indian bank account. So it was a very a crucial point and a clarification which brought no taxation for such individuals who are non-resident of India and working outside India and receiving salary in their Indian bank account. So there was this. So there was another. There were a lot of other favorable rulings which had again harped on the same point that salary received in India for services rendered outside India will not be taxable because it's accrued outside India.
So what happens if the employer is deducting taxes force in India?
Then you can claim, yeah, you can claim a refund. So ideally, actually, the employer is also not supposed to deduct TDS because that salary is not chargeable to tax in India. Conservative basis, exactly. Conservative basis, employers.
So it's okay, and a private job.
Hmm.
Typically, the person is being deputed outside India for services to the vendor there. Okay, he gets a living allowance there.
Exactly.
So the salary is here.
The main
The
salary.
company has deducted taxes for here.
Correct.
And on the living allowance, he's paid tax in that foreign country.
Hmm.
So there's kind of a.
But on the main salary also, he will be paying tax in that country.
We did what? Based on exactly the idea that you are propounding. What we did was we did not offer the income in India for tax and we claimed the TDS and 143 there is a huge press of it.
Yeah, but there have been
Then
cases
what
also.
we done?
No, so 143 one, I agree, will not because 26 AS will show a higher income than what you have reported. But at CIT levels or ICAT level, it is a justified position that salary income is not taxable in India. And TDS.
26 years is a mantra.
Mantra.
When you say you get it, not that you don't get it.
But that will lead to a lot of double taxation for individuals.
Then you keep going back and forth
Back and
with
forth.
CPC and finally you end up with
The AO.
skill officer, labor and
Uh,
taxation.
But we have now over the 2-3 years we have not seen so many complications because the income tax authorities have recognized this concept that salary could be paid in India, but it's for so you need to show it under exempt income as a DTAA benefit. Then they kind of try to match that even if it is exempt income, it is shown somewhere. Yeah, they will not issue notices.
Those
Yes. So this is what is there under the Income Tax Act. Now let's go to the DTAA provisions. Now DTAA also provides that if the resident country to tax that income, to tax the salary income, the clause is dependent personal services. It is termed as dependent personal services. Generally, Article 15 or 16 of the DTAA, whichever you are referring, it is generally Article 15 or 16. What it says is the right to tax the salary income is with the resident country if the services are also performed in that resident country. And the other country where the person is a non-resident, that country has a right to exempt that income. But provided three conditions are satisfied. One is he should be a resident of that overseas country. He should be exercising employment outside in that country, and TRC is obtained. If these conditions are satisfied, then salary, even if it is received in India for services rendered outside India, can be claimed exempt under the DTAA. So domestic laws also provide 912 is also pretty clear on this, but DTAA also substantiates this position. So to give an example, I've just quoted India-Australia DTAA Article 15, which reads that subject to the other provisions, salary and wages and other remuneration received by an individual who's a resident of, in our example, assuming if he's going from India to UK, who's a resident of UK in respect of employment shall be taxable only in UK unless the employment is exercised in India. So if it is employment is exercised outside India in UK, resident of UK, it will be taxable only in UK. Other country does not have the right to tax it. So it's just an example. Mr. X is a non-resident Indian working in Australia. He is seconded by his company to India for 3 years. So it's other way around. If the person was working in Australia for a number of years and now he's seconded to India for 3 years assignment, and his salary is continued to be Australia because that's the main parent company paying him, but he's working for the Indian entity. Will he be still required to pay income tax in India on his salary income? Any thoughts? They must be having in India. Exactly, yes. So, because services are rendered in India, it will be deemed to accrue in India as per 912, and therefore it will be taxable in India for a non-resident, even if the salary is received outside India. Like it's received in Australia, but services are rendered in India. So, Indian authorities have the right to tax it. In that case, I think he has to take up with the Australian payroll authorities. Not to deduct tax or maybe to avoid double taxation. Exactly. It's the other way around.
No, when you say he's seconded to India, doesn't that mean he's providing his services to his parent company in Australia?
No, because from Australia is coming to Indian entity. So it's seconded to India means seconded to the Indian entity for 3 years on a deputation or secondment. While its payroll continues because they don't want to transfer and then transfer back the payroll, maybe for convenience purposes, because everything is in Australia for him, so they want to continue the payroll. This is practical. We have seen a lot of countries.
Question was when he came to India for 3 years, then why did payroll moved to India?
So it is companies. So companies what generally do is they don't transfer because then they will have to transfer back after 3 years because the person is coming only for 3 years. And then his retirals in overseas country will also stop because his payroll has stopped. So he's contributing to social security in Australia. Then his retirals will have to be stopped. Like PF in India, there could be some social security contributions in it in Australia. So अगर वो stop हो गए तो there will be a lot of implications for him as a person. And as a company also, then they will transfer the payroll here. Then again payroll there, gratuity perspective, PF perspective. So we have seen a lot of foreign nationals coming to India, working for 1 year, 2 year, paid outside India only. Because they go on from India to Australia to Singapore, they keep on going. So the payroll can't shift to each and every country.
That company is not processing that cost to India. They also need that.
Yeah, that because cross charge is not one of the conditions actually, but because services are rendered in India, India has a right to tax it. So cross charge is not a condition to exempt that income. So maybe Indian employer has to do TDS on that salary which is processed outside India. Or the foreign employer will have to do TDS in India by obtaining PAN, or the Indian employer can also do TDS by deducting tax or by crossing up. Exactly. Generally, what happens is the employer in India will bear the tax cost of that employee coming to India. So it's grossed up. It's a perquisite.
They have to show that that person is the Indian employee.
For FRRO, so Indian entity will issue a certificate that he's working for the Indian entity. So Indian entity will have to show because he's working for the Indian entity. If the Indian entity will also provide him accommodation because he will not have any place to stay, so he will provide accommodation, benefits like car. There could be other. He will also have to contribute to social security, which is PF in India. So all that nuances do come along with a person coming to India. So everything he has to obtain PAN first of all. He has to file his returns. TDS has to be done by the employer. So this is other way around. If the Indian citizen who's on secondment to Australia, he renders services outside India, but he receives salary in India, still the salary can be claimed exempt under the DTAA, what we discussed on the DTAA provisions under Article 15(1) of the India Australia DTAA. So there are conditions which has to be satisfied that he should be a resident of Australia. He should be exercising employment and TRC can be obtained from Australian authorities. If that conditions are satisfied, then only of Article 15(1) exemption can be claimed. Else you can go under the domestic laws under 9122 exempt that income.
Madam, if the person is a resident of India, he is going outside for the employment and he is earning there. Since he is a resident of India, the entire global income is taxable. So what would be the
So if he's assumingly gone this year only, that's why he's qualifying to be a resident of India, and he's working overseas. So which we discussed in this. Exactly. I'll show you this case. April to October he was working in India. October se he went UK mein. He was a resident of India because 182 days condition gets satisfied. Now October to March he will be a resident of India as well as resident of UK. If that is situation, then you have to see the tiebreaker. Assuming he is non-resident of UK, तो इंडिया में टैक्स होगा एंड यूके का यू कैन क्लेम अ फॉरेन टैक्स क्रेडिट.
by filing the wrong payment.
67. FTC is 67. 10F is exemption. Any questions on salary, or we'll move ahead to the other source, other head of income? Yeah. Income from house property. Now, a non-resident Indian having house property in India or earning rental income in India is taxable in India as per the normal provisions, which are applicable to others as well, to the resident as well. Like self-occupied house property, you get a deduction only of the interest on housing loan up to 2 lakh. Rental property, the rental income is taxable and deduction is allowed for municipal taxes, standard deduction, and mortgage interest, and the net is taxable in India. So the same provisions, section 24, section 22 applies to a non-resident as well. The only difference here is when the rent is paid to a non-resident landlord. So if I'm a tenant, okay, and I am into renting a property from a landlord who's a non-resident, then the tenant has, when paying the rent, has to deduct TDS at the rate of 30%. Unlike the normal provisions where 50,000 limit is there and you have to deduct only at 10% or 5, I think 5% it was, 5% it was, yeah. So, and which is 194 IB and all. But for non-resident, if the landlord is non-resident, there is no limit, there is no 50,000 limit, or even if the rent is less than 50,000, it has to be deducted at 30% plus education cess under section 195, and also have to comply with the TDS filings like quarterly returns, or issuing form 16A to that landlord, because the TDS is deducted under 195. This requirement is eligible for AD. Like usually. Yes. So that's the hurdle which people face if the landlord is a non-resident. If you are, I don't know what is the benefit, because if that person is not having the 15 lakhs rent, maybe that refund, right? Because ultimately government is not getting anything. No, so the see 195's objective was only that non-resident, you have to deduct tax from the non-resident's income, because they don't have properties in India, or you cannot catch hold of them. Huh, sorry? They will not file return. But they will file because they have rental income. They will have to file claim a refund. Yeah. Typically, all these non-resident landlords that we are talking about are Indians. Yeah, Indians, exactly. And if they don't show that they are non-residents, you may end up, deducting TDS at the rate of 5% rather than 30%. But you need to know the person to whom you are paying is a resident or a non-resident. Also, the PAN has to be obtained from the tenant or from the landlord, so that it is reflected in the 26 AS of that person, so that he gets the credit of it. But we have seen where the non-resident and the tenant are entering to an agreement, and the address of the non-resident is the same flat. Same flat, exactly. And therefore, the tenant many times should not be like that. Environment of so much awareness. The tenant is not aware that the guy is a non-resident. Yeah. हाँ. He has a bank account with me. He has a PAN. He has an Aadhaar. He has an address. Yeah. And many times the brokers in between, sorry to say, but they play this kind of a game, Correct. Because they tell them अरे बोलेगा जरूरत नहीं है, देखो टैक्स आपका वोट कर देगा, पैसा इंडियन गवर्नमेंट के पास से आपको कभी आएगा नहीं, all kinds of things, Exactly. Yes. And generally what Indians think is citizenship अगर इंडिया की है तो वो रेसिडेंट होगा इंडिया का. So that is also a notion which is developed with people, but that if you are an Indian, you are a resident, so you're not no TDS type. Yes. So one case I know, this particular landlord, he stays in US. He hasn't been able to make his Aadhaar. His PAN is invalid right now. He has no mobile number. It's not what they do during the TDS. 5% of the delay in the Aadhaar. When the PAN is not needed. So it's inoperative. It's like inoperative PAN. Exactly. So I think 20% is the rate. So 20% will have to be, because he will get a TDS notice, which we have seen for employers. If employers are paying deducting tax on salary of employees and their PAN is inoperative, they get immediately notices.
Right. So 206 it will be 20.
Exactly, 206 will be 20%. Now it's very difficult to check and verify for each case whether the PAN is operative or not operative.
There are very means of it. How do you check if the PAN is active?
There is an income tax on the income tax portal. There is.
Then every PAN you have to check.
That's a hardship which is facing, but there is a facility given by income tax authorities.
So,
Individual, exactly. So this was one of the recommendations which we made to the government this year also, that this is causing a lot of hardship to the individual. At least you bring in some limit, 50,000 ka limit or some limit, or individuals, or you give a PAN option. They don't need to apply for TAN. They can also file it through PAN, which is also available. That option should also, it's an easier option because PAN to hoga sabke paas. TAN hona is, obtaining a TAN just for deducting TDS on rent is a hardship.
to be on a monthly basis.
On a monthly basis, exactly. Yes. Form 16A, which is a nuisance.
What is the federal provision not who has paid without rate?
The same non-deduction. Same. There's nothing different.
Challenge will come with some we deduct at 5% and at the year end he ends up being a return losses.
So maybe the differential.
When the year end is over, you will not know whether the person is going to still not know it. But is there any cross-checking income tax? How they will understand that?
For this, we haven't seen any cross-check happening or any notices issued that तुमने 30 के बदले 5% क्यों किया? Difficult.
Nowhere we can determine whether cost is going to be resident or not.
Correct.
How do I know whether he will be plan out after tax authority to determine whether the person is resident or not?
Until he files his return as non-resident. His return as non-resident. So the same provisions also apply when you are selling a property and the seller is a non-resident and you are a buyer. You are buying a property from a person who is a non-resident. So you need to deduct the tax and you need to file ETDS returns and the same provisions apply. 195 provisions apply. Yeah, so the 1% doesn't apply, which is for the residents, 1% doesn't apply. Yeah, right. So it's higher, and the PAN provisions also don't apply. Like for a residence, you can through PAN also you can go for TDS on property sale, 1%, and you don't need to obtain a TAN. You just through the PAN you can do it. But for non-resident, that provisions have still not been bought in by the government. They have to obtain a TAN, which is a hardship.
So typically what happens is if the transaction is in the month of January, 24% approximately on the sale consideration.
Sale consideration. Yeah, sale consideration.
Certificate is the story altogether. So typically 24% of the amount of the sale consideration is deducted, paid to the government, challan is shown, now that guy getting palpitations because Jan, Feb, March, the return is due by 30th of April. The TDS return. It will not reflect under his PAN until the TDS return is filed. So he's getting palpitations. First week of May में जाके मालूम पड़ेगा how we are going.
Unlike the other way where residents have it through return come challan or something, which is there.
I have a different take on this. Not don't misunderstand. Entry show के गए हो तो ये सब चलेगा. आपको फॉरेन इनवर्ड रेमिटेंस चाहिए और उसको
Now, this was domestic laws. Now, under the DTAA, what does the DTAA talks about house property? There is Article 6 generally in the DTAAs which talk about income from immovable property. So, the country of source where the property is situated, that country has a right to tax, primary right to tax it. So, that is how the wordings of the article also says that income from real properties may be taxed in the contracting state in which the property is situated. So that the right is given only to the country where the property is situated. So just an example, Mr. A is a resident of Australia and a non-resident of India. He owns a house property in India and receives rental income from such property in India. So is that income taxable in India?
Yes.
Yes. So that income is taxable in India because the house property is situated in India. But in Australia, since he's a resident, the Australian authorities can also say because he's a resident of Australia, that income can be taxed in India or taxed in Australia. So there could be double taxation in Australia. So from Australia perspective, he can take a relief under the DTAA to not not to tax, or may take a really foreign tax credit of whatever taxes he has paid in India.
If that income is not below the above 15 lakhs, then also it is taxable
For which
for non-resident.
yeah. So because residents are taxable deemed deemed to accrue, received deemed to received in India. So under that concept, it is taxable in India. Income from capital gains. Now, capital gains provisions for a resident and non-residents are similar if we don't go into the chapter 12a, but the general provisions are same, except there is one catch here. For a short term capital gain which is arising from an STT paid shares or mutual funds, 111A to be precise, you don't get the basic exemption limit, you don't get the chapter 6a, and the applicable rate is the same 15%, but you don't get basic exemption also. It's straight away 15%, unlike for residents where you get basic exemption and chapter 6a deductions. Now there are special provisions to non-residents, which is chapter 12a under the Income Tax Act, for investment income and long-term capital gains. Now, when is this section applicable? Now, this is applicable to non-resident Indians, means you have to be a citizen of India and you are a non-resident under the domestic laws. So these two conditions are there. The third condition is it is applicable only to foreign exchange asset, means the asset which is acquired in India or purchased in India through foreign currency. So if that type of asset you hold and you are earning an income out of that asset, or you are earning any long-term capital gain, then this special provisions, special rates are applicable. This chapter becomes applicable to you. So it has to be either an investment income like a dividend or an interest income, or a long-term capital gain. If you have investment income and long-term capital gain from foreign exchange asset, then this provision become applicable. So we'll see what is this provision saying. So provision says that investment income is taxable only at 20% flat instead of 30%, and long-term capital gain is taxable at 10% instead of the 20% or other rates which are applicable to a resident. However, no deduction will be allowed under Chapter 6A. Indexation benefit is not available to them. Any expenses which is incurred to earn that income is also not available. So these deductions are not available, but you get a lower rate of tax. But it's only applicable if that asset is bought in foreign currency. It's not INR. If you have bought that asset, it's not applicable. Then the normal provisions of capital gain becomes applicable. You mean it's not like from the NRI account that you but it has to be. NRI is also an Indian INR account. Huh. So it has to be from the NRI account. Yeah. FCNR account. Yeah. So which is a designated into a foreign currency account. Yeah. And if you have bought the asset from that, or shares of an Indian company, or debentures, or could be anything, then these provisions are applicable. Very rare provisions, like we have not seen very interaction on these provisions and people taking the benefit of this, because Indians don't buy in foreign exchange investments, or maybe they are not aware of this provisions. Could be.
Unless they have investment vehicles outside the country.
But this
amount that gets covered in this?
Yeah, it has to be. Now, for capital gains from so there is similar provisions which is there in the 54F also, that if you earn a long term capital gain and if you buy a new asset out of this net consideration within 6 months, then the proportion of such becomes exempt from tax. The asset has to be a long term capital asset. Net consideration must be invested in specified asset, and investment should be made in 6 months. If that being said, then the capital gain is exempt. So net consideration should be the The cost of new asset should be higher than the net consolidation. And if you have bought that new asset and you have sold that new asset within 3 years, then it becomes reverse. The capital gain becomes reverse. So I think that's the normal provisions, but they have also brought in this provisions in this special chapter as well. There's another provision 115G which says that if you have earned income from these assets only and TDS is already deducted on this, there's no tax due, then the NRI doesn't have to file returns in India. So there's a special provision which says that you have earned only income from such assets, which is investment or long term or both, and TDS is already deducted from this income, have not been and which is correctly deducted, then there is no requirement to file India tax return by the NRI. Anyone has practically dealt with these provisions? Because I have not done it practically, but this is
provisions relating to this is calculating capital gains in foreign currency.
Hmm. Which provisions?
There's an NRI. Then I have acquired sales. This by converting my some dollar remittance into rupee. And subsequently, when I'm selling it, at the time of sale, this on the I will convert that this on the sale value into this on the dollar and then
correct. So there was a rule. There is a rule, Rule 26, income tax rules, which tells you about that. What will be the exchange rate applied when you are calculating the capital gain? The date on which you have sold that asset, the exchange rate of that date has to be applied. So that rule is there, Rule 26, and there is another rule 115 or something. It's still there.
So sale value by converting that into dollars, and this one that I will make the cost of it will the dollar cost of it.
Of the same date.
And then this one gain. Dollar gain, I will convert back into this other
Rupee gain.
Yeah.
Yes.
Then provisions
Continue. Yes. So this is special provisions only for limited purpose and limited assets.
They're obtaining the CS certificate and bank certificate usually so much this one. In 94 something this one when we try to apply to this one, by the time this one the 116 depreciated currency twice, what I gain we had almost lost with it.
Oh.
We have to obtain a CS certificate, we have to obtain a bank certificate.
That took time.
Okay. There is some benefit was lost.
Okay. Now, capital gain, the tax under the DTAA, it also says that the right to taxes with the country where it is originated. There have been a lot of different opinion or different positions under each DTAA on this. That's why it's not very clear. So what it says, the India, Australia, to give an example, it says that income derived by a resident of, assuming India, from a alienation or sale of real property, which is a real estate property or a house property situated in other country, may be taxed in that other country. So it is very clear that if the property is situated outside India, or that shares or mutual funds or whatever capital asset is situated outside India, that country has the right to tax. The resident country may tax or may not tax, but the overseas country has the primary right to tax it. So if there is double taxation, foreign tax credit is the only way where you can exempt that income. Now, dividend and interest income. So, similar provisions are also there for dividends under the Income Tax Act. For a non-resident, it is 20% under 115A, where the domestic companies paying to a non-resident, they have to deduct TDS also at 20% plus applicable surcharge and cess. And also, when the NRI is filing returns in India, they will have to pay tax at 20%, which is a special rate tax. Unlike for the residents, which is at the slab rates. Similarly, interest income is taxable from a savings or an NRO account under the head income from other sources at applicable slab rates. And you also get 80TTA or 80TTB. However, if the interest is earned from an NRE account or an FCNR account by a PROI, which is a person resident outside India as per FEMA, then it is exempt from tax under Income Tax Act under Section 1042 of the Act. So that's NRE interest, FCNR interest is exempt for a non-resident. What does the DTAA tells? DTAA tells that both the countries will tax it if the dividend is earned, the country of source and the country of resident. However, the country of resident will tax only to the limited tax rate. So there is a beneficial rate available. So let me give you an example. It's a bit tricky here. India Australia DTAA, the first provision says that the resident state has the right to tax. So dividend paid by Australian company to Australian citizen, assumingly, will be taxed in Australia. Now, if that Australian citizen is also an Indian non-resident, then he will have to tax it at 15% because that's the second provision which says the source state will have the right to tax only at 15%. To give another example is Indian companies. Indian companies paying to non-resident in India, they are getting taxed at 20%. But under the DTAA, if they are paying tax outside India also, they are non-resident of India, they can also avail beneficial rate of 15%. So not 20%, but 15% taxation will apply under the DTAA. So example, assuming a Indian company distributing dividend to Mr. B on shares held by him, he is a resident of Australia and a non-resident of India. Can he claim beneficial rate of tax under Article 10 and what will be the taxation actually? So Mr. B is a non-resident in India and a resident of Australia. So as per 10, he can apply 15% taxation on dividend income. But under the domestic law, he has to pay 20%. So whichever is beneficial is the DTAA rate, which is 15%. However, this will be subject to obtaining TRC from Australia and filing Form 10F. So this is a beneficial rate which is available to non-residents in India to tax it at 15% and not 20% under the domestic laws if they get a TRC and a Form 10F. Similarly, such provisions are also there for interest income under the DTAA, which says that the resident state has the right to tax, but the source state can also tax it at 10 or 15 depending on each treaty. So each treaty has different rates, 5%, 10%, 15% to tax such income. So similarly, if a person who's a non-resident in India and a resident of Singapore and he's earning savings interest in India, then he can pay the tax not at 30%, which is the applicable slab rate, but 15%. Because it's as per the treaty, he can pay it at a lower rate. However, he has to obtain tax residency certificate from Singapore and also E10F has to be filed by him. Then only he can tax it at 15%.
It's legal only for interest.
Interest dividend also we saw in the earlier slide. Dividend also similar 15. Some treaties say 15, some say 20, some say 10. So depending on treaty, the relief can be taken. So practically what we have seen is we have been taking this 15% taxation for individuals. But if Form 10F is not filed, you get a notice, immediate notice or an intimation that since 10F is not filed, you cannot take treaty relief and your income is proposed to be taxed at slab rates rather than beneficial rate. So 10F TRC is very important before claiming such exemptions or reliefs. Now I'll just go through FEMA regulations. You have time. FEMA regulations for an Indian working abroad, when they are going for the purpose of employment, they need to redesignate their account as an NRO NRE account. So whenever you are advising clients for the people who are going out of India, leaving India, they need to redesignate their account. They need to inform their bankers that I'm going out of India for purpose of employment. I'll be staying outside India. I'll be an NRI. Then my account from a normal saving account, it has to be redesignated to a NRO NRE account. NRIs are permitted to make investments in India through their funds in India or repatriated funds. They are not allowed to open a new PPF account or a savings account, but if they have an existing one, they can continue to contribute to those funds. They can invest in immovable properties in India. They are permitted to remit foreign currency to India. There is no limit. But when you want to repatriate funds from India to overseas, there is a limit of USD 1 million.
But here can be only for the period of validity. It cannot be extended.
Sorry? Huh.
See, it's only for a period of validity of the existing account. Yes. See, it's
Exactly, 15 years. You cannot extend it if you are a non-resident. Correct.
so 1 million is per year.
Per financial year.
Yes, time limit for redesignating this one of the current
Sorry.
savings account. Time limit within which this one the current savings account is to be redesignated as a NRO or this one.
Immediately, actually. It has to be whenever you're going, you need to inform your banker that I'll be going and you need to redesignate the account to NRO. Because there is, I think, from the banker side also, there are a lot of issues they have to face if a non-resident is having a savings account in India from their perspective. Because they deduct TDS also then on interest, on savings interest, FD interest. Yeah.
Sale of property proceeds to be remitted out of the country. $1 million applies or the entire amount can be remitted.
If it is if it is sale of property, the remittance, it's a taxable. Yeah, 1 million is freely transferable. It's a capital gain, a capital receipt, and not a current account receipt. So 1 million limit will apply to that. Only current account it is freely transferable without 1 million limit. Current capital account transaction 1 million is the limit for it.
Current account, any amount you will transfer.
Yeah, with 15 CACB you can transfer.
Yes, no.
Sorry. Yeah, for individuals. Individuals. No, no. For if an individual has an Indian bank account and they have some money lying in India and they want to transfer, some interest is earned, and that interest they want to transfer outside India, they can transfer. But 15 CACB will be required. Depending on the whatever the amount is, the banker will ask for it. But they can remit outside India. Now, there are three types of accounts which are generally opened. One is the FCNR, one is the NRE, and the NRO. FCNR is a fixed deposit account, whereas NRE, NRO are kind of current saving. It could be any type. It is in the Indian rupee account, but FCNR is in the foreign currency, or it could be dollar, it could be pounds, or any other currency account. The funds are repatriable from FCNR to and NRE, but NRO current income you can transfer, but other than current income, it has to be 1 million limit is there. And if you want to transfer more than RBI approval is option is available to them. And people do keep account based on the requirement. So NRE account is generally to park their overseas earning to India, whereas NRO account is their Indian earnings. It's an if they have Indian income like rent, dividend, they can park that money in the NRO account because it's freely repatriable account as well. Now, practical considerations. Any questions before we move on? We have some time as well. Yeah.
So, generally, practically what we see in as you were mentioning that in small practices, when we are being asked to issue PCACB by our clients, at that moment when we are issuing that certificate, we are never given TRC or form. And in one of my client assessment procedure, we had asked for during the year after जितना 15 CACB issue किया उसके रिजल्ट लिस्ट इस पार्टी को किया क्या इशू किया क्या अमाउंट किया तो उसका उनको प्रॉपर्ली प्रेजेंटेड चाहिए. Now out of I remember out of 20 odd parties, we didn't have a TRC of almost 16 odd parties.
Oh.
Okay. Now that's not on the part that I was not aware that we have to take TRC and then issue. You know, completely aware. But we have on record and we are trying to same issue करो मतलब that is one small client how they interact with us. So in that scenario, like we got a lot like against fraudulent assessment because they were saying that we have some mandatory. We just wanted to know that how far it is mandatory or territorial in nature that it has to be obtained only then you can do that lot of issue cases. So you read whatever amount. The point is, client is not very appealing to look for CIKP. We will practice everything. But the thing is, we as a CA, we know that okay, this is wrong. But is there anything backup in case law which says that okay, 10 FTR 16 mandatory is
लेवल तक मैंडेटरी है सर, आपको वो करना जरूरी है तभी आप इशू करो, बिकॉज उसमें क्या होगा, मैं आपको एकदम ऑनेस्टली आप लोग डोंट टेक इट
हाँ
अदरवाइज नहीं चले जाएगा, बिकॉज मैं बोल दूंगा
हाँ
कि यार सिंह लोगों ने ठीक से नहीं दूंगा, तो मैं ठीक है मैं दूंगा, बस ये मतलब
आई अग्री.
so is there any practice wherein like if I can let's say insist a client नहीं आप CATV फाइल और फाइट करनी है ठीक है.
No, no. So 15 CACB, we haven't come across any case law, but for exemptions, DTAA exemptions like interest ka ya salary ka, which we take in the India tax return, there is a case law which tells that just not having TRC cannot deny your exemption. So there was a favorable law, case law. Because that assessee didn't have TRC, that doesn't mean that you will deny his exemption. If he has valid things to prove that overseas में that income is taxable, overseas return है जिसमें residential status is written, everything, he had lot of proofs, other proofs to substantiate that he was resident. Just not having TRC cannot be a denial. हाँ, TRC होगा तो ही 10F फाइल होगा. हाँ, so it's a subsequent event which is happening. But what we have practically seen, lower authorities will not allow you exemption. तुरंत नोटिस आ जाएगा कि तुमने 10F नहीं भरा है, ठीक है. बट लिटिगियस है, depends on the ITAT or the jurisdiction. There's only one case law favorable. Others are not a favorable case laws to us.
Case law with respect to form 67 that is actually
67 के लिए बहुत है. Exactly.
directorial is not mandatory enough.
Exactly. But 10F is not there. There is no such case law which says that for 57, 67 there is a lot of case laws and 67 तो pass through हो जाता है. If you have not filed 67 and you have claimed, वो भी CIT या ITAT level पे होगा, not at lower authorities. हाँ.
67 now generally accepted.
Yeah. हाँ, it is mandatory, but because like 143(1) में if you have in the return filing you have claimed FTC foreign tax credit and you have not filed form 67 तो 143(1) में वो add करके आ जाएगा income में. But you can argue that by some reason we did not file form 67. Form 67 is nothing, just you need to put in the details कि कितना तुमने tax overseas में भरा है and you have to attach a proof, maybe a overseas return or a like a salary slip होता है वैसे some kind of form 16 or something which shows that taxes are paid outside India, or a self declaration is also okay with it. So if form 67 is nothing great to file, it can be filed easily by people who claim it. But TRC is, you have to, that overseas authority have to issue that form, and there are nuances that the overseas authority may not issue form within the timeline which we require it, or for the period which we require it, or the details which we want them to write. So every country has their own regulations, so it's not streamlined, but there is a mandatory requirement to have TRC which cannot be denied. So any other practical, you all have you come across any difficulties while dealing with NRIs, or pretty straight? Yeah.
One more.
Yeah.
So there's a president person of Australia. He is earning salary. He's staying there almost last 10 years now. Now he is planning to shift back to India on a permanent basis. But in the past almost 6 years, every month's salary which he was receiving, he was transferring, let's say, example, let's say July की salary 5th of August को उसको credit दी. 7th of August he was transferring to back to India. Not the whole amount, but 80% of the amount. So in that scenario, and he has not been filing return in India at least. In the past, almost out of his 10 years, he has not been filing for last 5 years. Okay. So now he's permanently wanting to shift back to India. In the past, he has been doing this transaction every now and then. So any effect in terms of PANMA or income tax for those back end things which he has done?
No.
And or he has transferred back every monthly basis pay. And it's like not comparing anything. There's actually not done anything. You are just simply transferring into his account. यहाँ से फिर उसकी mom के account पे.
Correct. So remittance of tax or remittance of income from overseas to India is not taxable. There's no remittance tax in India.
Yeah, not
So
but in terms of any other compliances which he needs to take care of when he is permanently shifting back and he has been
permanently shifting back to India, he'll have to start filing his return. And for the previous years, if he had income and he's not filing, then that's an issue. That's a non-compliance. Did he has any other income in India other than the salary which he's earning in Australia? like house property, could be interest, could be.
See, this is all claim in his mother's name.
So if and his mother is filing the returns, so there is no, under his PAN there is no income. The AIS is blank, the 26 AIS is blank. Then he is not required to file returns in India. So there is no complications. Once he is back in India, he has to start filing his return.
That account there.
Hmm.
All the capital gains, whatever he has invested in US stocks and
Hmm.
everything. He wants to close that, come back. Now he'll shift that fund also here.
Correct.
Then also not again.
Not an issue.
Because
But
he's selling it out there and then
so there he will have to pay capital gain tax as per the Australian laws. But and if when he is transferring to India, you will have to also see the residential status in India. So assuming he is getting transferred in June July, उसके बाद पूरा साल इंडिया में रहेगा, he'll be more than 182 days, he becomes a resident of India. Residents are taxable on global income. So global income taxable हुआ, so जो भी ऑस्ट्रेलिया में he has earned for that financial year, maybe capital gain, salary income, that becomes taxable in India. And you have to claim a foreign tax credit of whatever taxes are paid. But there is a lot of hardship. Foreign asset दिखाने पड़ेंगे as foreign schedule FA. FA schedule in the FSI is income. FA is for foreign asset reporting in the income tax return. Yeah. So all that will be there if he's a resident of India in the year he's coming. So he has to plan his visit in such a way that he is less than 60 days in India during that year, so that he's non-resident of India. So he comes in maybe February or March. He's a non-resident. He doesn't have to show overseas income. The next year onwards becomes a fresh year when he will be only in India.
This is what I keep
63, 65 days also becomes a criteria for a person who's coming to India.
But this is 365 days, so this is then after 4 years in
If that is not condition, then 182 days lag jayega. Yeah. So any of the conditions, 182 days, 63, 65, which if it is not, should not get satisfied to qualify as a resident. Even 730 days nahi hoga if he is staying, since 10 years. But he should be a non-resident. My point is, if he's non-resident, he's safeguarded from foreign income being taxed in India. But he's resident, then there is a lot of complications, which we generally tell our clients not to come to become a resident. You come at the end of the year, you would know, or when you're going out of India, go before September, less than 182 days, so you become a non-resident. So so something of that sort. Now, practical consideration, one of the point is there have been a lot of debates on whether the person is leaving for the purpose of employment. When we are determining residential status, one of the condition is 182 days criteria is only for people who are leaving for the purpose of employment. Now, what is purpose of employment? It's not defined under the Act. Can it be said that he's going India, he should be unemployed in India and then he's taking up new employment? There has been ruling which says that it's not necessary that the person has to take up new employment. Even deputation secondments are considered as purpose of employment. However, if the person is just going for training or a short tourist visit, that is not employment purposes. The intention should be working for the overseas country on a secondment or new employment. Even the type of visa which he's taken. So one of the case law also provided relevance on the type of visa. If the person is going on tourist visa or medical for medical reasons and he has not obtained a business visa or a employment visa, then he cannot be said that he is going for the purpose of employment. Even there have been case laws which says that British gas, which was very important case laws in 2006, which said that an individual need not be unemployed in India. So it's not that taking up new employment. Had it been the purpose of the law was taking up new employment, they would have written that for the purpose of taking new employment outside India. But the intention of the law is that you are going for a secondment or for employment outside India, and the benefit is given to such individuals. So there have been case laws, but it is still a gray area where people make interpretation depends on the case to case basis.
person is also doing a PhD here. It's a 5 year research there.
But it's still a study.
Yeah, it's still a study, but they have to do research and for which they are just being made stipend.
But there's no employer-employee relation. Is there an employer-employee relationship? So then it's not employment, ideally. So that employer-employee relationship has to be.
It's a 5 year contract and research.
Exactly. So it's kind of medical or maybe education purpose.
Yes.
Education purpose. Yeah.
We are supposed to do a research for the university for which university makes a time.
Correct.
The contract is for a period of time. The contract.
Right. So the intention is not employment, the intention is study.
Yes.
So, the intention has to be looked in while determining the residential status. The 182 days beneficial thing cannot be. On TRC, I think we have discussed a lot on availability of TRC. The third is on withholding. So, under Section 192 salary, the section does not expressly specify that withholding has to be taken after taking treaty relief. Nor any of the TDS provision says that you have to do the withholding after taking treaty relief. It has to be expressed in the act itself that withholding has to be taken after treaty relief to avoid having withholding and claiming a refund then, because people who have been paid in India and not taxable because they are rendering services outside India, the salary is not taxable in India. So therefore, withholding should not apply to them. But Indian companies do the withholding on a conservative basis because 192 is not very clear on that. So they do the withholding and then at the return filing stage, the employees claim a refund of that. Where the problem lies, yeah. And then scrutiny comes in. The tax rates under DTAA, so the tax rates which are the beneficial rate, 15%, 10%, that is all that on that you cannot apply surcharge and cess. That is the final rate available to an individual. However, the income tax website, the forms which are available, if you apply the 15%, the surcharge and cess get automatically calculated. So that's a hardship which people are facing, that why do I need to pay 15% plus surcharge and cess, whereas the DTAA is very clear that this is my final rate of tax. So, but there is no solution to it because the income tax return forms are designed in such a way that the surcharge and cess do come on the beneficial rate which is available under the TT. I think we can take up questions or any practical experience if anyone wants to want to share with us. We have some 10 minutes. Anyone?
ESOP income, what is the treatment which is there?
ESOPs, which are Indian ESOPs or foreign ESOPs?
Foreign.
Foreign ESOPs. So if a person is working in India,
Yeah.
so what happens? ESOPs income from grant to vest. So grant to vest. There is a vesting period of 3 years, generally in companies. So where the person is there for that 3 years, assuming 2010 to 2013, the grant to vest, and after the vest, he is eligible to have those share in his account, in his demat account or whatever account it is. So for the 3 years, the person, if he was working in India, then it is taxable in India, the entire gain. Now the gain is calculated by the number of shares into the fair market value of that share minus whatever is recovered from the employee. That becomes the gain, and on that perquisite taxation is already there under salary, TDS.
For example, he was in US for if by a back.
Hmm.
Now he is selling the shares in US.
Selling,
Yeah.
which is already he's got in his demat account from ESOP.
Right.
Yeah. So selling is, and if the person is non-resident in India and selling in US, it's not taxable in India.
Now he is in India.
Achha, he's a resident in India. Okay. Yeah, it will be taxable because global income becomes taxable for him. And sale price minus whatever was considered as perquisite value, whatever is the difference becomes the taxable value in India. And if any taxes are paid in US on that same income, a foreign tax credit can be claimed to avoid double tax.
Actually, he is getting dividend that US has deducted 20% tax, but on the gain, there is no tax.
Okay. Maybe TDS is not there, but at the return filings, TDS filing they may so there could be possible. Any other questions? So I think that's it. Thank you.